Welcome to the Deep Dive, the place where we unearth the most essential knowledge and insights hidden within your sources. Forget information overload. We're here to give you the shortcut to being truly well-informed with just enough surprise and maybe a bit of humor to keep you listening.
That's right. We take the complex stuff, break it down, and help you connect the dots, drawing directly from the materials you provide us.
Absolutely. And today, wow, we are plunging into a topic that is, well, fundamental to modern life, something you probably interact with all the time, yet its inner workings can feel, I don't know, shrouded in complexity. Insurance. Our deep dive today is guided by the principles laid out in Principles of Risk Management and Insurance, which is really a foundational text in the field.
Yeah, it's a solid source. It provides a really robust framework for understanding not just what insurance policies do, but why the whole system is structured the way it is. It gets right down to the bedrock principles.
So, our mission for this deep dive, tailored specifically for you, the listener, is to pull back the curtain on insurance. We're going to explore the core ideas, lift the lid on how insurance companies actually operate and, make money, understand the crucial role regulation plays, see how something like your credit history fits in, and get really specific by dissecting, say, your personal auto policy.
Yeah, hopefully you'll see that bill you pay every month or year in a totally new light.
Exactly. Get ready.
It's really about moving beyond just the transaction, the payment, and understanding the powerful mechanism behind it, how it transforms potential financial catastrophe into, well, manageable certainty for millions of people.
Okay, let's unpack this. We really have to start at the very, very beginning. What is insurance at its most fundamental level? What kind of problem is it even designed to solve?
Well, at its heart, insurance is a technique, a mechanism for handling pure risk.
Yeah.
And that term pure risk is really key here. It refers to a situation where there are only two possible outcomes.
Yeah.
Either a loss occurs or, nothing happens. There's no potential for gain. Think about your house burning down. That's a pure risk. You either suffer a massive loss, the house is gone, or you don't. It's distinct from what we call speculative risk, like investing in stocks.
Right, where you could gain or lose money.
Exactly.
Yeah.
With speculative risk, there's a possibility of loss or gain. Insurance, fundamentally, only concerns itself with those pure risks, the downside only possibilities.
Got it. So insurance isn't about helping you make money. It's purely about protecting you from losing it in specific, unplanned, often catastrophic ways. And how does it actually achieve that protection?
It achieves it through this core mechanism of risk transfer. You, whether you're an individual homeowner, a driver, maybe a large corporation, you transfer the potential financial consequences of a pure risk, like the cost of rebuilding that burned house or paying for damages after a car accident. You transfer that from your shoulders to the insurance company.
In an exchange.
In exchange, you pay a relatively small, predictable amount, the premium.
So instead of facing the possibility of a sudden, potentially bankrupting financial hit, I pay a smaller, regular amount, and the insurer basically agrees to take on that potential big hit if it happens.
That's the essence of it.
That sounds like a pretty good deal for me, the individual. But how does the insurer make this work financially? How can they afford to take on all these huge potential losses?
They make it work through the other absolutely foundational concept, the pooling of losses. This is really the engine that allows risk transfer to function on a large scale.
Pooling, okay.
The basic idea is that the losses experienced by the few unfortunate members within a defined group are paid for by the premiums collected from the many members in that same group.
Pooling. Let's really dig into this because it feels like the core principle of loss sharing. It's not some kind of magic trick. It's math and, well, group cooperation, isn't it?
Precisely. Insurance doesn't, magically prevent the bad thing from happening. A fire can still happen. An accident can still occur. What insurance does is acknowledge that bad things will happen to some people in a large group. And it prearranges the finances so that when a loss does hit one member of that group, the financial burden isn't solely on them. It's shared across all the members.
Making it manageable for the person who actually suffered the loss.
Exactly.
Yeah.
So instead of one person being financially ruined by, say, a house fire, a large number of people each contribute a small amount, their premium. And that collective pool of money is then used to cover the significant damage suffered by the few. It effectively smooths out the financial volatility for the individual by distributing it across the entire group.
That makes sense. The source uses a classic example, right? Like early fire insurance.
Yes, it's a great illustration. Imagine a town with, let's say, 10,000 homes. Each home is valued at maybe $300,000.
Okay.
Now, historical data, experience, shows that on average, maybe 20 of these 10,000 homes will suffer a total loss due to fire each year. That's a total potential loss of $6 million across the town, 300,000 times 20 homes.
Which is devastating for those 20 families.
Absolutely devastating. But if all 10,000 homeowners chip in and each pay a relatively small premium, say $700 per year.
Okay. $700 times 10,000 homes.
That's $7 million in total premiums collected. That collective pool of $7 million is then sufficient to cover the average expected losses of $6 million from those 20 fires, with some money left over for the insurer's operating expenses, profit, and maybe some unexpected variations.
So the large, unpredictable potential loss for the few becomes a small, predictable cost, the premium for the many. That really clarifies how pooling works. It turns potential disaster into a manageable expense.
It does. But crucially, this entire system hinges on the insurer being able to predict with reasonable accuracy how many losses, like those fires, are likely to occur within that large group.
Right. How do they figure out that it's likely to be 20 fires, not 2 or 200? How do they make that prediction?
That brings us directly to another cornerstone principle, the law of large numbers. This is the statistical bedrock that makes pooling financially viable and predictable for the insurer.
The law of large numbers. Okay.
What the law essentially states is that as the number of exposure units in a group increases.
Exposure units, meaning the things being insured.
Yeah.
Like the houses, cars, people.
Exactly. As the number of similar exposure units you're observing increases, the actual loss experience for that group will get closer and closer to the expected loss experience. That is, the underlying probability of loss calculated from past data.
Okay, so you can't predict if my specific car will be stolen next year, or if my roof will get damaged by hail.
No, predicting individual events is impossible.
But
If an insurer looks at, say, 1 million similar cars in similar geographic areas, or 1 million roofs in a region known for hail, the law of large numbers tells them that the actual number of thefts or hail claims within that massive group over a given period will be very, very close to the statistical probability they've calculated based on historical patterns.
it's like the coin flip example, right? Flip a coin just 10 times, you might get a weird result. Maybe 7 heads and 3 tails. That's pretty far from the 50-50 probability.
Right. Very possible.
But flip it 1 million times.
Flip it 1 million times, and you're going to get something incredibly close to 500,000 heads and 500,000 tails. The random variations cancel out over a large number of trials.
So the larger the pool of similar risks the insurer has, the more accurately they can predict the total amount of losses they'll likely have to pay out for that group.
Precisely. And this predictability is absolutely essential for rate making, the process of determining how much premium to charge. It allows insurers to set premiums that are sufficient to cover those expected losses and their operating expenses for the group, while still trying to remain competitive in the market.
Without the law of large numbers, insurance would just be a gamble for the insurer, wouldn't it?
It really would. It provides the mathematical confidence needed to make the whole system work financially.
Okay, so pooling is the how of sharing the financial burden, and the law of large numbers is the how of predicting the total burden for the group. These two concepts really are the absolute foundation.
They are. But, even with these powerful principles, insurers face some significant challenges that could potentially undermine the stability of that pool. One of the most persistent and difficult is something called adverse selection.
Adverse selection. That sounds like something negative is being selected. What does that mean?
It is negative for the insurer, potentially. Adverse selection is the tendency for individuals who have a higher than average probability of experiencing a loss to be more likely to seek out or to continue holding insurance coverage at standard rates compared to those people who have an average or lower than average risk.
So basically, the people who sense they need the insurance the most are the ones most eager to buy it, especially if the price seems like a good deal for their level of risk.
Exactly. And think about it from the insurer's perspective. If they can't accurately identify and price that higher risk presented by these individuals, then the pool they assemble ends up containing a disproportionate number of these high-risk individuals compared to what the standard premium was actually designed to cover based on an average risk level.
I see the problem. If the insurer set their premiums based on assuming, say, an average risk of 1 fire per 100 homes, but because of adverse selection, the group they actually insured has an average risk of 2 fires per 100 homes,
then their premiums won't be enough to cover the actual claims.
Exactly.
This leads to the insurer experiencing higher than expected claims payouts.
Which means they lose money on that pool.
Right. And to compensate, what might they have to do?
Raise premiums for everyone in the pool.
Probably. But when premiums go up, who is most likely to think, this insurance is getting too expensive for me?
The lower risk people, the ones who think, I'm unlikely to have a claim anyway, why pay this higher price?
Precisely. So the lower risk individuals start dropping their coverage. This leaves an even higher concentration of high-risk people remaining in the pool,
Which forces the insurer to raise premiums again.
driving away more low-risk people, potentially creating this downward spiral, sometimes called an insurance death spiral, which can make that line of insurance unsustainable.
Wow, that sounds like a serious threat to the whole pooling concept. How do insurers fight against adverse selection? What's their defense?
The primary weapon against adverse selection is underwriting.
Underwriting, okay.
Underwriting is the process insurance companies use to select and classify applicants for insurance based on their potential for loss. Insurers gather a lot of information.
Like what?
Oh, through the application itself. Maybe medical exams for life or health insurance, sometimes inspecting property for homeowners insurance, reviewing driving records for auto insurance, or using other data sources like the insurance credit score we'll get into later.
And what do they do with all that information?
They use it to assess the true risk level of each applicant. Based on that assessment, they make a decision. They might accept the application at standard rates if the risk looks average. They might reject the application altogether if the risk is deemed too high or doesn't fit their underwriting guidelines. Or, importantly, they might accept the application but place the applicant into a higher risk classification, which means charging a higher premium that more accurately reflects that individual's increased likelihood of loss.
So underwriting is basically the insurer trying to make sure that the people joining the pool are paying a premium that's actually appropriate for the level of risk they bring to that pool.
Exactly. It's trying to prevent the high-risk individuals from unfairly benefiting from rates that were designed for average-risk individuals. It's all about risk classification, grouping similar risks together and charging them accordingly to maintain the financial health and, frankly, the fairness of the insurance pool.
That makes sense. It's a necessary countermeasure. Okay, so beyond these core mechanics, pooling, prediction with large numbers, managing adverse selection through underwriting insurance contracts, also operate within a specific legal framework, right? The source highlights several key legal principles.
Yes, absolutely. These legal principles are crucial for how insurance contracts function and are enforced.
What are some of the most important ones we should understand?
Well, let's start with a really big one, especially in property and casualty insurance. The principle of indemnity.
Indemnity, okay.
The fundamental idea here is that the insured person or entity should not profit from the loss. The goal of the insurance payment is to restore the insured to the same financial position they were in immediately before the loss occurred. No better, no worse, just back to where they were financially.
So if my insured car is damaged in an accident, the insurance pays to repair it or pays its value if it's totaled, but not so much that I end up making money from the whole incident.
Precisely. The source emphasizes this. The goal is restoration, not enrichment. And this principle serves some really vital purposes.
Like what?
Well, first, it helps prevent what's called moral hazard.
Moral hazard.
That's the risk that someone might intentionally cause a loss or maybe exaggerate the extent of a claim if they knew they could actually gain financially from the insurance payout. If you can't profit, there's much less incentive to cause a loss on purpose.
Right, prevents fraud.
Yes, and relatedly, by limiting the payout to the actual loss suffered, it generally discourages property losses and fraudulent claims overall. It keeps the focus on recovery, not gain.
How is the actual amount of the loss determined under this principle? If my 10-year-old sofa burns up, how do they decide what it was worth?
Good question. The source mentions a few common methods used to determine the value and stick to the indemnity principle. One very common one, especially for older property, is actual cash value, or ACV.
ACV.
ACV is typically defined as the replacement cost of the property minus depreciation due to age, wear and tear, and obsolescence. So for that 10-year-old couch, you wouldn't get the price of a brand new top-of-the-line couch today. You'd get its current value, considering how much it had depreciated over those 10 years.
Okay, so ACV accounts for the fact that things wear out. What are other methods?
Another important one is replacement cost coverage. This is often available, sometimes as an optional upgrade, particularly for homes and sometimes contents. Replacement cost coverage pays the cost to replace the damaged property with new property of similar kind and quality, without deducting for depreciation up to the policy limits.
So with replacement cost, I could get a new couch to replace the old one.
Yes, generally, subject to policy terms and limits. It provides a higher level of recovery than ACV, especially for older items. There's also market value, which is often used for real estate, what the property would reasonably sell for on the open market just before the loss. And sometimes, especially for unique or hard-to-value items like fine art, antiques, or collectibles, you might have a valued policy. In this case, the insurer and the insured agree on the value of the property at the time the policy is issued. If a total loss occurs, that pre-agreed amount is paid, regardless of the ACV or market value at the time of loss.
Interesting. So the method used really depends on the type of policy and the item insured.
Exactly. But the underlying goal is usually indemnity making you whole, not rich. Another critical legal principle is utmost good faith.
Utmost good faith. That sounds serious.
It is. Insurance contracts are considered contracts of utmost good faith. This imposes a significantly higher standard of honesty and disclosure on both parties, the applicant insured and the insurer, than you'd typically find in most other commercial contracts.
A higher standard? What does that mean in practice, if I'm applying for insurance?
It means that both sides are expected to voluntarily disclose all material facts to each other, even if not specifically asked. A material fact is any piece of information that would likely influence the other party's decision about whether to enter into the contract at all, or influence the terms of the contract, like the premium amount or the specific coverage offered.
So I can't just answer the questions asked. I have to proactively tell them anything important they should know.
That's the spirit of it, yes. The source specifically discusses violations of this principle. One is concealment. That's the intentional failure to disclose a material fact that you know you should disclose.
Like not telling your auto insurer you use your car for pizza delivery when you applied for a personal policy.
That could certainly be concealment if it's material to the risk and rating. The other violation mentioned is misrepresentation, that's making a statement that is actually false regarding a material fact.
Like saying you've never had a speeding ticket when you actually have several.
Exactly. And the consequences can be severe. If an insurer can later prove that the applicant intentionally concealed or misrepresented a material fact when applying for the policy,
What can happen?
they may have legal grounds to void the policy entirely, right from the beginning, as if it never existed. Or they might deny a claim, even if that specific claim isn't directly related to the concealed or misrepresented fact.
Wow. So being completely accurate and truthful on your insurance application is absolutely critical. Hiding something, even if it seems small, could potentially leave you with no coverage when you need it most.
Absolutely. It really underscores the high degree of trust required for the whole insurance system to function effectively. It's a two-way street of honesty.
Okay, that's utmost good faith. What's another key legal principle?
A third essential legal principle, particularly relevant again in property and casualty insurance, is the principle of subrogation.
Subrogation, that sounds technical. Break that down for us. What does it mean in simple terms?
Subrogation basically means that after an insurer has paid a claim to its own insured for a loss that was caused by some third party.
Like someone else crashing into my parked car.
Exactly. After your insurer pays you for the damage to your car, the principle of subrogation gives the insurer the right to recover the amount they paid you from that at-fault third party, the person who actually caused the damage.
So my insurance company pays me, and then they essentially step into my shoes to go after the person who hit my car to get their money back.
That's a perfect way to put it. The insurer acquires the insured's right to sue or pursue recovery from the responsible party.
Why does this exist? Why not just let me sue the other person if I want to?
The source outlines a couple of main reasons for subrogation. First, it prevents the insured you, in this example, from collecting twice for the same loss.
Once from my insurer, and then again by suing the guy who hit me.
Exactly. That would violate the principle of indemnity we just talked about. You shouldn't profit from a loss. Subrogation prevents that double recovery.
Makes sense. What's the second reason?
Second, it helps to hold the negligent or responsible party accountable for the loss they actually caused. It ensures that the ultimate financial burden falls on the person who was at fault, not just on the innocent insured's insurance company. And importantly, by allowing insurers to recover some of the money they pay out in claims caused by others, subrogation helps keep overall insurance costs down for everyone else.
Okay, that makes a lot of sense too. It ensures fairness, prevents double dipping, holds the right people accountable, and helps control costs. So, Indemnity prevents profiting, utmost good faith demands honesty, and subrogation lets the insurer recover from the party who caused the loss. These legal principles really provide the essential scaffolding for the whole insurance mechanism.
They absolutely do. They work hand in hand with the pooling and risk transfer concepts we started with. Now that we've kind of laid out the fundamental what and why and the legal ground rules,
Right.
let's turn our attention to the entities that actually make all this happen. The insurance companies themselves. How are they structured? Who owns them? And how do they actually get their products, their policies, to you, the customer?
Great transition. The source talks about different ways insurance companies are owned and organized. What are the major types we should know about?
The two most prevalent ownership structures discussed in the source are stock companies and mutual companies. Their fundamental difference really boils down to who owns them and what their primary objective is.
Okay, let's start with stock companies. They sound like typical corporations.
They are, essentially. Stock companies are owned by their stockholders or shareholders, just like most publicly traded companies you might think of. Their primary objective, therefore, is generally to generate profits for those shareholders. Control of the company is vested in a board of directors, and those directors are elected by the stockholders.
And if they make profits?
Any profits earned can be distributed to the stockholders in the form of dividends or reinvested in the business. A key advantage of this structure, as the source notes, is their ability to raise capital relatively easily by selling additional shares of stock. This capital can be used to support growth, fund acquisitions, or strengthen their financial position.
Okay, so stock companies are ultimately about returning value to their investors, who may or may not actually be policyholders themselves. How do mutual companies compare to that?
Mutual companies are distinctly different. They are owned entirely by their policyholders.
The customers own the company.
Yes. There are no external stockholders. Because of this ownership structure, their primary objective is typically not maximizing profit for outside investors, but rather providing insurance protection to their owner policyholders at the lowest possible cost.
Interesting. Who controls them then?
Control still rests with the board of directors, but these directors are elected by the policyholders. And any surplus funds or profits they generate, meaning premiums collected, exceed claims and expenses aren't distributed to external shareholders.
So what happens to the extra money?
It can be used in several ways to benefit the policyholders. It might be used to reduce future premiums, or perhaps to increase policy benefits, or it could be distributed back directly to the policyholders in the form of policy dividends.
So in a mutual company, the policyholders wear two hats. They're both the customers and the owners. And the company's focus is primarily on providing value back to them, not generating profits for outside investors. That feels like a pretty significant philosophical difference from a stock company.
It really is. The source mentions there are even variations within mutuals. Historically, there were accessible mutuals, where policyholders could actually be required to pay extra premiums if the company's losses were unexpectedly high, but those are pretty rare nowadays for most lines.
Yeah, I wouldn't like that surprise bill.
No kidding. The most common type today is the advanced premium mutual, where you pay your premium upfront, and that premium is fixed for the policy term. The source also mentions fraternal insurers, which are a type of mutual that provides life and health insurance specifically to members of a particular social, religious, or charitable organization.
Okay. The source also notes a trend, especially in life insurance, where mutual companies convert into stock companies. What's that called? Demutualization.
Yes, demutualization.
Why would a company owned by its policyholders choose to become owned by stockholders?
That's been a notable trend over the past few decades. Mutual companies might pursue demutualization primarily to gain better access to capital. As a stock company, they can issue stock to raise funds much more easily than a mutual can.
And they'd use that capital for
things like funding major expansions, making acquisitions of other companies, investing in new technology, or diversifying their business lines. Converting to a stock structure can also provide more flexibility in areas like executive compensation plans and potentially allow for quicker strategic decision-making, which some feel can be more constrained in a mutual structure that's solely focused on policyholder interests.
interesting trade-offs there, changing the fundamental ownership structure, mainly to get easier access to capital. Are there any other types of insurers mentioned besides stock and mutuals?
Yes, the source briefly touches on a couple of others worth noting. One is Lloyd's of London.
Lloyd's, famous name.
Very famous, but unique. Lloyd's isn't actually a single insurance company. It's more accurately described as a marketplace, or a society, where individual members or groups called syndicates, which can be backed by corporations or individuals, come together to accept insurance risks. Each syndicate underwrites risks for its own account. Lloyd's is particularly known for insuring large, complex, or unusual risks that standard insurers might shy away from.
So it's a collection of insurers, almost.
In a way, yes, operating under a common structure and oversight. Another type mentioned is a reciprocal exchange. This is an unincorporated group where individuals or businesses, called subscribers, agree to insure each other.
They insure each other directly.
Essentially, yes. The group is managed by an attorney, in fact, which is usually a corporation authorized to handle the administrative tasks like collecting premiums, paying claims, and managing the exchange on behalf of the subscribers. It's like a formalized risk-sharing pool among the members themselves.
Okay, so we have different ways insurers can be owned and structured. Now, once a company is set up, regardless of its structure, how does it actually get its policies to people like us? What are the marketing channels or distribution systems they use?
Right. Insurers use various systems to sell their products and reach potential customers. The source outlines the main approaches they take.
What are the primary ones?
One major system is the agency system. This involves using agents as intermediaries to sell insurance. But there's a key distinction within this system between two main types of agents.
Okay.
First, you have independent agents. These agents are typically independent business owners who represent and sell policies for multiple different insurance companies, sometimes dozens.
So they're not tied to just one company.
Correct. This means they can, in theory, shop around among the various insurers they represent to find coverage and pricing options that best fit your specific needs. They can compare quotes from different companies for you.
That sounds beneficial for the customer.
It can be. And crucially, independent agents typically own what are called the expirations or the renewals. This refers to the information about your policy, your coverage, and importantly, your renewal date. Ownership of expirations means that if you decide you want to switch insurance companies when your policy renews, you can often do that while staying with the same independent agent, who can then place your business with a different insurer they represent.
So the relationship is more with the agent who can access multiple companies. What's the other type of agent?
The other main type is the exclusive agent, sometimes called a captive agent. As the name suggests, these agents represent and sell policies for only one specific insurance company or a group of companies under common ownership.
So they work for just one brand, basically.
Yes, they might be direct employees of that insurer, or they might be independent contractors, but their contract restricts them to selling only that one company's products. In this system, the insurer usually owns the expirations.
Meaning
Meaning if you decide to leave that particular insurance company, you'll almost certainly need to find a new agent as well, because your current captive agent can't place your business elsewhere.
Got it. Independent represents many companies and owns the client relationship, broadly speaking. Captive represents just one company, and the insurer owns the relationship. What about brokers? How do they fit in?
Brokers are another type of intermediary, and they are particularly prominent in commercial insurance, dealing with businesses, although they exist in personal lines too. The key distinction for brokers, according to the source, is that they primarily represent the insured, the customer, rather than the insurance company.
So they work for me, the buyer.
Legally and ethically, yes. Their role is to act on behalf of their client, the insured, to survey the marketplace, solicit quotes from various insurers, even ones they don't have a formal agency appointment with, and negotiate the best possible coverage terms and pricing for the client's specific needs.
Okay, that covers the intermediary side, agents, and brokers. What about methods where you deal more directly with the insurance company itself, without necessarily going through an agent?
That's where the other main systems come in. One is the direct writer system. In this system, the salespeople are actual employees of the insurance company. They work out of company offices or call centers and sell the insurer's products directly to consumers.
So like a captive agent, but they're actually employees.
Often, yes. And similar to the captive agency system, the insurer owns the expirations in the direct writer model.
Okay. And the other direct method?
That's the direct response system. This system completely bypasses face-to-face agents or even employee salespeople. Insurers using this method market and sell their policies directly to consumers through channels like direct mail, telephone solicitations, television advertising, and increasingly, and perhaps predominantly now, the internet.
Ah, so this is like the companies whose websites urge you to get a quote online in minutes or call their 800 number directly.
Exactly those. You interact directly with the company, usually through their website or call center, to get quotes, purchase policies, and often manage your account.
That seems like it could potentially lead to lower costs, maybe lower premiums, since they're not paying agent commissions in the same way.
That's often the argument, yes. By streamlining the distribution chain, direct response insurers can potentially reduce their operating expenses, which might translate into more competitive pricing. The trade-off is often that the consumer takes on more responsibility for understanding their own coverage needs and comparing options, as they don't have the personalized advice and guidance that a dedicated agent, whether independent or captive, might provide.
Makes sense. You might save money, but have to do more homework yourself. Does the source mention any other distribution methods?
It does note that many companies today actually use multiple distribution systems.
Yeah.
They might use captive agents for some products or regions, independent agents for others, and also have a strong direct online presence, trying to reach different customer segments through different channels.
Covering all the bases.
Right. And it also mentions the role of financial institutions, like banks, sometimes getting involved in selling certain insurance products, particularly things like life insurance or annuities, often leveraging their existing customer relationships.
So the way you actually buy your insurance, whether it's through an independent agent giving you options, a captive agent representing one brand, a broker acting for you directly from the company's employee, or just clicking buttons online, that choice can really affect your whole experience, right? The level of advice, the service you get, maybe even the cost. It's not just a minor detail.
Not at all. It's a fundamental part of the insurer's business model and directly shapes the relationship and interaction you have with your insurer. So, okay, we've discussed the structures, stock, mutual, etc., and how they reach you through these different channels. Now let's pull back the curtain even further and look at what actually happens inside an insurance company once they've sold you a policy and collected your premium. What are their key day-to-day operations?
Yeah. Besides the initial selling and pricing, which involves those rate making and underwriting functions we touched on, what are the core processes that keep the lights on and, most importantly, fulfill that promise to pay claims when things go wrong?
You're right to mention rate making and underwriting again. While we discuss them as fundamental concepts for pricing and selecting risk, they are absolutely core operational functions within the company, involving actuaries, underwriters, data analysts, and so on. But beyond that initial stage, some absolutely critical ongoing operations include claims adjustment, reinsurance, and investments.
Claims adjustment. That seems pretty straightforward on the surface. Someone makes a claim, the insurer investigates, and hopefully they pay it. But I'm guessing there's a lot more complexity involved than just writing a check.
Oh, absolutely. There's significant complexity, and the claims function is arguably the most crucial operation from the customer's perspective. This is the moment of truth, right? It's when the insurer actually delivers on the promise that the policy represents.
So what's the goal? Just to pay.
The goal of claims adjustment isn't just to pay claims, but to do several things. First, verify that a loss that is actually covered under the terms of the policy has occurred. Second, determine the cause and, importantly, the amount of that loss fairly and accurately. And third, based on that, pay valid claims fairly and promptly while also resisting fraudulent claims or exaggerated amounts. It's a balancing act.
What are the typical steps involved when someone files a claim?
The source outlines the usual sequence of events. First, typically there's the notice of loss. The insured person contacts the insurer by phone, online portal, app, whatever, to report that an incident or loss has occurred.
Okay, step one, tell the insurance company.
Right. Then comes the investigation phase. An adjuster is usually assigned to the claim. Their job is to gather all the relevant facts about the loss. How did it happen, when, where, what was the extent of the damage, were there any witnesses, are there circumstances that might affect coverage under the policy?
What does that investigation look like?
It can involve a lot of things, depending on the type and size of the claim. It might involve inspecting the damaged property, like your car or house, interviewing the insured claimant's witnesses, maybe reviewing police reports for an accident, obtaining medical records for an injury claim, getting repair estimates, and so on.
You mentioned an adjuster. Who are these people? Are they always employees of the insurance company?
Not necessarily. The source actually points out there are different types of claims adjusters. Company adjusters are salaried employees of the insurance company who investigate and settle claims on behalf of their employer.
Okay.
But insurers also often use independent adjusters. These are individuals or firms who are hired by insurance companies as independent contractors to handle claims, often in specific geographic areas where the insurer doesn't have its own staff, or maybe during catastrophic events like a hurricane when the insurer's own staff adjusters are overwhelmed with claims. They still work for the insurer, but aren't direct employees.
Gotcha. Okay, so after the investigation, what happens next in the claims process?
After the adjuster has gathered the facts, the insured is typically required to submit a proof of loss. This is a formal sworn statement made by the insured, providing details about the loss, the circumstances, and the amount being claimed, often accompanied by supporting documentation like repair bills, inventories of damaged items, medical bills, etc.
Sort of the official claim document?
Yes. And finally, based on the adjuster's investigation, the proof of loss, and the terms and conditions of the insurance policy itself, the insurer reaches a decision on the claim. They will either decide to pay the claim in full, pay it partially, if some parts aren't covered or amounts are disputed, deny the claim entirely if it's determined not to be covered under the policy or if fraud is suspected, or perhaps negotiate a compromise settlement with the insured.
That whole process makes sense. It's designed to ensure the claim is legitimate, the amount is accurate according to the policy, and the payment is handled properly. Okay, what about another key operation you mentioned? Reinsurance. You called it insurance for insurers. That sounds a bit strange. Why would an insurance company need insurance itself?
It does sound a bit circular at first, doesn't it? But reinsurance is absolutely critical, especially for property and casualty insurers. It's exactly what it sounds like. A transaction where one insurance company, called the ceding insurer, transfers some or all of the potential loss associated with certain risks it has insured to another insurance company called the reinsurer.
But wait, I thought the whole point of insurance was that companies handle risk by pooling large numbers of similar exposures, using the law of large numbers to predict outcomes. If they do that properly, why would they need to offload risk to another insurer? Don't they already have enough risks pooled together?
That's a great question. Even with effective pooling and diversification across many individual policies, a single massive catastrophic event could still generate claims so enormous that they overwhelm the financial capacity of even a large primary insurer.
Like what kind of event?
Think about a major hurricane hitting a densely populated coastal area like Florida or the Gulf Coast, or a severe earthquake striking California, or maybe a massive industrial explosion or a large-scale terrorist event. The total insured losses from such an event could run into the tens or even hundreds of billions of dollars. No single primary insurer, no matter how large, could likely absorb its share of such losses without potentially becoming insolvent.
So reinsurance is mainly about protecting the primary insurer from those huge, potentially company-busting catastrophic losses.
That's a primary and critical reason, yes. Reinsurance is a vital tool for managing these peak catastrophe risks and protecting the insurer's overall financial stability and solvency. But the source actually lists several key reasons why insurers use reinsurance. Protecting against catastrophes is one. Another is to increase their underwriting capacity.
Increase capacity? How?
Reinsurance allows a primary insurer to take on larger individual risks or write more business in a particular area than its own capital base would otherwise safely permit. By ceding a portion of that risk to a reinsurer, the primary insurer frees up its own capacity to write more business.
Okay, so they can insure bigger things or more things. What else?
Reinsurance is also used to stabilize profits. By transferring away some of the potential for large, unexpected losses, reinsurance can help smooth out an insurer's year-to-year financial results, making earnings less volatile and more predictable for their shareholders or policyholders.
Reduces the big swings.
Exactly. The source also mentions it can help insurers reduce their required unearned premium reserve. That's a technical accounting and regulatory requirement. But basically, ceding premiums to a reinsurer can sometimes improve certain financial ratios. And finally, reinsurance can be used as a way for an insurer to withdraw from a particular line of business or geographic area gradually by reinsuring the existing policies rather than just canceling them outright, which provides continuity for policyholders.
Okay, I'm starting to see how crucial it is. It's like the primary insurer is spreading its own risk even further, especially for those really big or concentrated exposures, preventing any single major event from potentially wiping them out. The analogy you mentioned earlier about a large ship spreading its valuable cargo across several smaller ships to reduce the risk of a single total loss. That really fits reinsurance well.
It's a very apt analogy. Reinsurance is a fundamental risk management tool for the insurers themselves, operating largely behind the scenes, but essential for the stability of the entire industry.
Okay. And the final core operational area you mentioned was investments. How does investing fit into the day-to-day business of an insurance company? It seems different from underwriting or paying claims.
It is different, but it's massively important, especially when it comes to the company's overall profitability. Think about how insurance works. Companies collect premiums from policyholders upfront, often months or even years, before claims related to those policies are actually paid out.
Right, there's a lag time.
A significant lag time, especially for certain types of insurance. For many property casualty claims, payment might happen within weeks or months. But for liability claims, it could be years before a lawsuit is settled. And for life insurance policies, claims might not be paid for decades after the first premium was collected.
So the insurance company is holding on to a lot of money the premiums collected for potentially a long time before they need to pay it out.
Exactly. They hold vast sums of money known as reserves, which represent funds set aside to pay future claims and obligations. And what do they do with all that cash in the meantime? They invest it.
Ah, they invest the premiums they collect.
Precisely. They invest these reserves in various financial assets, bonds, stocks, real estate, mortgages, etc. The income generated from these investments, interest, dividends, capital gains, is a critical and often very substantial source of revenue and profitability for insurance companies.
So they're essentially earning money on the money they're holding before they eventually have to pay it out in claims.
That's exactly right. And this investment income can often be the difference between an insurer reporting an overall profit or a loss, particularly in the property and casualty insurance sector. In many P&C lines, competition keeps premiums relatively low, sometimes so low that insurers frequently experience an underwriting loss, meaning they pay out more in claims and the expenses of running the insurance operation than they collect in premiums.
They lose money just selling the insurance.
It happens quite often, especially during certain phases of the market cycle. But even with an underwriting loss, the company can still be highly profitable overall if its investment income earned on those large reserves is strong enough to more than offset the underwriting loss.
That's a crucial insight. Profit doesn't just come from premiums minus claims. Investment income is a huge piece of the puzzle.
A huge piece. The source also points out that the types of investments insurers make tend to differ based on the nature of their liabilities, the claims they expect to pay.
How so?
Life insurance companies, for example, have very long-term liabilities. They know they'll have to pay death benefits eventually, but often many decades in the future. Because of this long time horizon, they can typically invest a larger portion of their assets in longer-term, potentially higher-yielding, but less liquid assets like stocks, real estate, and long-term bonds.
Okay. And property casualty insurers?
Property and casualty insurers, on the other hand, face liabilities that are generally shorter term and often less predictable in timing and amount. Think car accidents, house fires, storm damage. They need to maintain greater liquidity to be able to pay claims quickly when they occur. Therefore, P&C insurers tend to invest more conservatively, with a larger proportion of their portfolio typically held in high-quality, relatively shorter-term bonds and other liquid assets.
That distinction, based on the time horizon of their potential claims, makes perfect sense for their investment strategies.
Wow.
This whole flow of money premiums coming in, being held and invested, generating income, and eventually flowing out as claims payments, that leads us right into discussing how insurers actually measure their financial performance and profitability.
Absolutely. Understanding their finances is really key to understanding the business model. As you just noted, their two main streams of revenue are the premiums they earn from selling policies and the investment income they generate from their reserves. But measuring profitability, especially on the core insurance side of the business, requires some specific metrics that are unique to the industry.
Okay, what are the key metrics we should know about for assessing profitability, particularly the underwriting side, the insurance part itself?
By far, the most important metric used in the property and casualty insurance industry to evaluate pure underwriting performance is the combined ratio.
The combined ratio.
This single ratio cleverly combines the two main cost components of the insurance business relative to the premiums earned. It gives you a snapshot of whether the insurer is making or losing money just from writing insurance policies before considering any investment income.
How is it calculated? What goes into it?
It's calculated as the sum of two other key ratios, the loss ratio and the expense ratio.
Loss ratio and expense ratio. Okay, what's the loss ratio?
The loss ratio is calculated as incurred losses plus loss adjustment expenses divided by earned premiums. Incurred losses are the claims paid during the period, plus changes in the reserves set aside for future claims payments. Loss adjustment expenses are the costs associated with investigating and settling those claims, things like adjuster salaries, legal fees, etc. Earned premiums are the portion of premiums written that actually correspond to the coverage provided during that specific period. So the loss ratio basically tells you how much the company is paying out or expects to pay out in claims and claim-related costs relative to the premiums that is actually earned for providing coverage during that time.
Got it. Claims costs as a percentage of earned premiums. And the expense ratio.
The expense ratio is calculated as underwriting expenses divided by written premiums. Underwriting expenses are the operational costs of acquiring and managing the insurance business, things like agent commissions, advertising costs, salaries of underwriters and other staff, rent, taxes, etc. Written premiums are the total premiums on policies sold during the period. So the expense ratio reflects the operational cost of running the insurance business relative to the volume of premiums written.
Okay, so loss ratio covers the claims side, expense ratio covers the operating cost side, and the combined ratio is just those two added together.
Correct. Combined ratio is loss ratio plus expense ratio. It essentially represents the total outflows related to the insurance operation, claims, claim expenses, underwriting expenses, as a percentage of the premiums, using a mix of earned and written premiums in the standard calculation as we described.
So how do you interpret that combined ratio number? What does it tell you?
It's actually quite straightforward. A combined ratio under 100%, say 95%, indicates an underwriting profit. It means that for every dollar of premium the insurer earned, or wrote, depending on the precise formulation, it paid out only 95 cents in claims and associated expenses. They made a 5-cent profit purely from the insurance transaction itself.
Okay, under 100 is good underwriting profit. What if it's over 100?
A combined ratio over 100% indicates an underwriting loss. If the ratio is, say, 103.4%, as an example the source might use, that means for every dollar of premium earned or written, the insurer spent 1.034 cents on claims and the expenses of running the underwriting side of the business. They lost 3.4 cents on every dollar just from selling the insurance.
They lost money on their core business activity.
Exactly, an underwriting loss. And this is the crucial point we discussed with investments, and the source emphasizes it. An insurer can still be overall profitable, even with a combined ratio over 100%, meaning an underwriting loss. If their investment income earned on their reserves is strong enough to more than offset that underwriting loss. This happens frequently, especially in highly competitive P&C markets, where intense price competition drives premiums down, pushing combined ratios above 100%. The insurers rely on investment income to make their overall profit.
That really ties back clearly to the importance of the investment side of the house. So the combined ratio tells you specifically about the profitability of the insurance operations themselves, but it doesn't give you the whole financial picture. Is there a metric that does show the overall profitability?
Yes, there is. That's the overall operating ratio. This ratio takes the combined ratio we just discussed and adjusts it for the impact of investment income. Specifically, it's calculated as combined ratio minus the investment income ratio.
Investment income ratio.
Yeah, the investment income ratio is simply the net investment income earned divided by the earned premiums.
Yeah.
So the overall operating ratio subtracts the contribution of investment income relative to premiums from the combined ratio.
So if the combined ratio was 103%, an underwriting loss, but the investment income ratio was 10%, the overall operating ratio would be 103%. 10% equals 93%.
Exactly. A 93% overall operating ratio indicates a strong overall profit, even though the company lost money on underwriting alone. This ratio provides the full picture of the company's financial performance from its core activities, both underwriting and investing.
Okay, that's really helpful. Combined ratio strictly for the insurance side, overall operating ratio for the total business picture, including investments. That's a key distinction for understanding how these companies actually make money.
Definitely. These metrics are absolutely essential tools for insurance analysts, regulators monitoring solvency, and investors trying to assess an insurer's performance and financial health. Which actually brings us very naturally to the whole crucial area of regulation. Who watches over these complex financial entities handling billions of dollars and making promises far into the future?
Yeah, that's a good question. Why is insurance so heavily regulated? I mean, it's a business like any other, selling a product or service, isn't it? Why all the extra oversight?
Well, insurance is different from selling, say, cars or computers in some fundamental ways, which necessitates a higher level of regulation. The source highlights several critical reasons and objectives for this regulation, many of which tie directly back to the principles and operations we've already discussed.
What are main reasons?
First and foremost is ensuring insurer solvency.
Solvency, meaning they don't go bankrupt.
Exactly. Making absolutely sure that insurance companies have the financial strength and stability to meet their obligations and pay claims when they come due, especially potentially massive claims following widespread disasters. Remember, when you buy insurance, you're not buying a tangible product you take home today. You're buying a promise of future payment, sometimes many, many years in the future.
Right, a promise that has to be good when you need it.
Precisely. If that promise can't be kept because the insurer becomes insolvent, the economic and social consequences for individuals, families, and businesses can be absolutely devastating. So, protecting the financial stability and solvency of insurers is paramount.
Okay, solvency is number one. What else?
Another major goal is consumer protection. This involves preventing unfair or deceptive practices by insurers or agents, ensuring that policy contracts are written in reasonably clear language, making sure claims are handled fairly and promptly according to the policy terms, and providing avenues for consumers to file complaints and seek redress.
Protecting the customer from being taken advantage of.
Yes. Then there's the regulation of rates. Regulators typically want to ensure that insurance rates are not excessive, so consumers aren't overcharged. Not inadequate, so low that they threaten the insurer's solvency, and not unfairly discriminatory, so people with similar risk profiles are charged similar rates.
But balancing affordability, solvency, and fairness in pricing.
It's a tricky balance. And finally, regulators are often concerned with ensuring the availability of insurance, especially for essential coverages, like auto or homeowners insurance. They might take steps to make sure coverage is accessible to those people who need it, sometimes through mechanisms like assigned risk pools for high-risk drivers who can't find coverage in the voluntary market.
So the core purpose of all this regulation is really protecting that promise to pay, ensuring the system's overall stability, and maintaining fairness for the public who rely on it.
That sums it up well.
In the United States, where does this regulation actually happen? Is it federal or state or?
That's a key feature of the U.S. system. Insurance regulation is primarily handled at the state level, not the federal level. This dates back to the McCarran-Ferguson Act of 1945, which essentially affirmed the state's authority to regulate and tax the business of insurance.
So each state has its own set of insurance laws and regulators.
Yes, exactly. While there's coordination, the primary authority rests with the individual states.
Now let's shift gears slightly to talk about a specific tool that insurers use in their rate-making and underwriting processes, one that the source notes is sometimes controversial: insurance credit scoring.
Ah, yes, the insurance score.
Many people are familiar with their regular credit score, like a FICO score that lenders use. What exactly is an insurance score and how is it different?
That's a really important distinction to make. An insurance score is a numerical score derived from information found in an individual's credit history, much like a standard credit score. However, and this is crucial, while it uses information from your credit report, the scoring models and the algorithms used to calculate an insurance score are specifically designed and statistically validated for the purpose of predicting insurance risk, not credit risk or lending risk.
So it's using the same underlying data, like my history of paying bills, how much debt I have, etc., but it crunches that data differently to predict something else.
Precisely. The resulting insurance score number is different from, say, your FICO score that a bank would use to decide on a loan or a credit card application. The factors might be weighted differently, and the score range might be different.
And why do insurers use these scores? What are they trying to predict?
Insurers use them, as the source points out, because extensive research conducted by the insurance industry and actuarial organizations has indicated a statistical correlation between certain characteristics found in an individual's credit history and the likelihood that that individual will file insurance claims in the future, particularly for personal lines like auto and homeowners insurance.
Hold on. Why would my credit history predict if I'm going to get into a car accident, or if my house is going to get burglarized, or if a tree is going to fall on my roof? That seems counterintuitive to a lot of people. What's the connection?
That's exactly where the controversy often lies, as the source acknowledges. The connection isn't necessarily claimed to be causal in a direct, easily explainable sense like bad credit causes accidents.
Right.
Instead, insurers use it as a predictive tool based on observed statistical correlations found in very large data sets over long periods. Their data suggests that certain patterns of credit management behavior are statistically correlated, on average, with a higher or lower propensity to file insurance claims.
What's the theory behind why that correlation might exist?
Theories vary, but some suggest it might reflect broader underlying habits related to responsibility, planning, financial stability, or maybe how people generally manage risk or maintain their property, which could indirectly influence their likelihood of experiencing or reporting insured losses. But from the insurer's perspective, the primary justification is simply that the data shows a statistically significant correlation, making it a useful factor among many others for predicting future losses.
Okay, so they use it as an input in their underwriting and rating processes.
Yes, they use the insurance score as one factor, alongside driving record, location, vehicle type, age, etc., to help assess the overall risk profile of an applicant and to determine the appropriate premium to charge. The goal is to more accurately segment risks and price policies accordingly.
And does having a better insurance score typically lead to paying less for insurance?
Generally, yes, that's the outcome. A higher insurance score is usually associated by insurers with a lower predicted risk of filing claims, and this often translates into lower premiums for auto and homeowners insurance. Conversely, a lower insurance score can lead to significantly higher premiums, or in some cases might make it more difficult to obtain coverage from preferred insurers.
What specific aspects of a person's credit history are typically factored into calculating an insurance score? Is it the same stuff as a regular credit score?
The source indicates that the key elements considered are largely similar to those used for traditional credit scores, although again, the weighting and specific calculations might differ. These typically include your payment history. A consistent record of paying bills on time is usually positive. Amounts owed, how much debt you carry relative to your available credit limits, high credit utilization can be negative. The length of your credit history, a longer history can be positive if it demonstrates consistent responsible behavior. New credit, opening many new accounts in a short period can sometimes be viewed negatively. And the types of credit used or credit mix. Having a mix of different types of credit like credit cards, installment loans, mortgages, and managing them all can be positive.
Okay, so it's looking at similar patterns of financial behavior. You mentioned this is controversial. What are the main criticisms leveled against the use of insurance scoring?
The primary criticisms, as the source notes, tend to revolve around issues of fairness and the potential for bias or disparate impact. Opponents argue that using credit history, which can be negatively affected by factors sometimes outside an individual's control, like sudden job loss, major medical expenses leading to debt, divorce, or simply a lack of access to traditional credit products, may unfairly penalize certain individuals.
Especially maybe people from lower socioeconomic backgrounds or minority groups who might statistically have lower credit scores for reasons unrelated to how safely they drive or how well they maintain their home.
That's exactly the concern. Critics argue that it can disproportionately harm these groups, even if those individuals personally manage risks responsibly. There's also the point you raised earlier, the philosophical objection that the statistical correlation doesn't necessarily prove a direct, logical, or causal link between someone's credit habits and their actual risk of having a car accident or a house fire. It feels unfair to some that factors seemingly unrelated to the insured risk are influencing the price.
Have these criticisms led to any action?
Yes. Because of these concerns about fairness and potential discrimination, the use of credit-based insurance scores is regulated, sometimes heavily, by many state insurance departments. Some states place restrictions on how insurers can use the scores, for example, prohibiting them from using credit score as the sole reason to deny coverage or non-renew a policy, or limiting its weight in the overall rating formula. A few states have even prohibited the use of credit scoring for certain lines of insurance altogether.
So it's clearly a powerful predictive tool for insurers based on their data, but it's one that raises significant and ongoing questions about equity, fairness, and causation. It's definitely a complex area where data science bumps up against broader social impact concerns.
It absolutely is. It's a perfect illustration of how the constant search for more accurate risk prediction and classification in the insurance industry can sometimes intersect with, and even conflict with, deeply held societal values about fairness and equal opportunity.
Wow. We have covered a tremendous amount of ground in this deep dive. We started with those bedrock concepts of risk transfer and pooling, saw how they're powered by the law of large numbers, but also challenged by adverse selection. We explored the different structures of the companies providing this service, stock versus mutual, and the various ways they market and distribute their policies to reach you.
Right, the agents, brokers, direct writers.
We looked behind the scenes at their core operations, digging into claims handling, the crucial role of reinsurance, and the importance of their investment activities.
And how they measure success with things like the combined ratio.
Exactly. We dissected how they measure their financial health with metrics like the combined ratio and the overall operating ratio. We delved into that sometimes debated tool for predicting risk, the insurance credit score. And now, to bring all this together and make it really concrete and practical for many listeners, let's take a final deep dive into a type of insurance almost everyone encounters: personal auto insurance.
Excellent idea. The personal auto policy, or PIP, is probably the most common property and casualty insurance policy that individuals purchase. While the exact forms can vary slightly by state or company, the basic structure and coverages are fairly standardized. Understanding its different parts is absolutely crucial for knowing what protection you actually have when you're out on the road. It's typically broken down into several distinct coverage sections, usually labeled Part A, B, C, D, and so on.
Okay, let's walk through the key parts. What's the first most fundamental coverage that people usually think about and that states require?
That would definitely be Part A, liability coverage. This is arguably the most important part of the policy because it protects your assets if you are found legally responsible for causing bodily injury or property damage to other people while operating your vehicle.
So this isn't coverage for my car or my injuries, right? It's for the damage I might cause to someone else or their property.
Exactly. If you cause an accident that injures someone in another car, or a pedestrian, or damages someone else's vehicle, or even non-vehicle property like a fence or a building, your part of liability coverage pays for their damages, things like their medical bills, lost wages, pain and suffering, and the cost to repair or replace their damaged property up to the liability limits you have purchased on your policy. It covers your legal obligation to others.
You mentioned limits. How do those work? I often see numbers like 255025 or 100, 300, 100. What do those mean?
Right, those are called split limits, and the source explains them. Let's take 255025 as an example, which might be a state minimum limit. The first number, $25,000, is the maximum amount the policy will pay for bodily injury expenses for any one single person injured in an accident that you cause.
Okay, max per person.
The second number, $50,000, is the maximum total amount the policy will pay for bodily injury expenses for all persons injured in that single accident, regardless of how many people were hurt.
Max per accident for injuries.
Correct. And the third number, $25,000, is the maximum amount the policy will pay for damage to other people's property, their car, fence, etc., in that one accident.
Max per accident for property damage.
I see. So the limits cap how much the insurance company will pay out on your behalf.
Yes. And it's crucial, as the source stresses, to understand that state minimum liability limits like 255025 are often very low compared to the actual costs of a serious accident today. Medical costs can easily exceed $25,000 for one person, and the cost of modern cars means property damage can quickly surpass $25,000 too.
So I cause more damage than my limits cover. Then you could be held personally responsible for paying the amount exceeding your limits, potentially putting your personal asset savings, home, future wages at risk. That's why most insurance professionals strongly recommend purchasing liability limits significantly higher than the state minimums to adequately protect yourself financially. Some policies also offer a combined single limit, CSL, which provides one total maximum amount that applies to both bodily injury and property damage liability combined per accident, offering a bit more flexibility.
Okay, so Part A, liability, is crucial for protecting yourself financially from claims by others you injure or whose property you damage. What's next? Part B.
Yes, Part B is typically medical payments coverage, often called MedPay or sometimes personal injury protection, PIP, depending on the state and policy specifics. This coverage pays for reasonable and necessary medical expenses and sometimes funeral expenses incurred by you, the insured, and any passengers riding in your covered vehicle if you were injured in an auto accident.
Okay, so this covers medical bills for people in my car. How is that different from the liability coverage we just talked about? Liability covered injuries to others, right?
Exactly. Liability, Part A, pays for injuries you cause to others. Medical payments, Part B, pays for injuries to you and your passengers. But here's the other key difference. Medical payments coverage pays regardless of who is at fault for the accident.
Regardless of fault.
Yes. If you or a passenger in your insured car is injured in a crash, your MedPay coverage can help pay for your initial medical costs up to the limit you selected, which is usually a smaller amount, like $1,000, $5,000, or $10,000 per person. Whether the accident was your fault, the other driver's fault, or even if no one else was involved, like if you hit a patch of ice and slid into a tree or swerved to avoid hitting a deer.
Ah, okay. So liability is for the other party's injuries damage when I'm at fault. MedPay is for my passenger's injuries no matter whose fault it was. That distinction is really important.
It is. MedPay provides quick access to funds for immediate medical treatment without having to wait for a determination of fault.
Got it. What about Part C?
Part C is uninsured motorists coverage, often abbreviated as coverage. This coverage is designed to protect you and your passengers if you are injured in an accident caused by another driver who is legally liable for the accident but either has no liability insurance at all or is a hit-and-run driver who cannot be identified.
So if someone illegally driving without insurance crashes into me and it's clearly their fault, my coverage steps in.
Yes. It essentially pays for the bodily injury damages, like medical bills, lost wages, pain, and suffering, that you and your passengers sustain up to the limits you selected, that you would have been legally entitled to recover from the at-fault uninsured driver if they had liability insurance.
So my coverage acts like the liability insurance the other guy should have had.
That's a great way to think about it. In some states, coverage might also cover property damage to your vehicle caused by an uninsured driver, but often it's primarily for bodily injury. Many policies also offer a related coverage called underinsured motorists, coverage.
Underinsured.
Yes, coverage applies if you're hit by an at-fault driver who does have liability insurance, but their liability limits are too low to cover the full extent of your bodily injury damages. In that case, after you've collected the maximum from the other driver's policy, your coverage can kick in to pay the remaining amount of your damages up to your limit, minus what you receive from the other driver.
Wow. Given that some people drive uninsured, and many others might only carry those low-state minimum liability limits we talked about, and coverage seem incredibly important for protecting yourself and your family from drivers who can't pay for the harm they cause.
They are often considered vital coverages, yes. Depending on the state, they might be required or optional, but they provide a crucial layer of protection.
Okay, so Parts A, B, and C are mainly about injuries and liability. What about damage to my own car? Where does that fit in?
That's covered under Part D coverage for damage to your auto. This part of the policy pays for direct and accidental loss or damage to your covered vehicle. It's typically optional coverage, unless required by a lender if you have a car loan or lease, and is usually broken down into two distinct types of coverage.
Two types. What are they?
The first is collision coverage. Collision coverage pays for damage to your car that results from its impact with another vehicle or object, like a tree, pole, guardrail, building, pothole, or if your vehicle overturns or rolls over.
And does fault matter for collision coverage?
No. Just like medical payments coverage, collision coverage pays for repairs to your car, regardless of who is at fault for the collision. If you accidentally back into a pole, or if someone runs a red light and hits you, or even if you cause a multi-car pileup, your collision coverage would apply to repair the damage to your own vehicle after you pay your deductible.
Ah, the deductible.
Yeah.
Right. That's the amount I have to pay out of pocket before the insurance kicks in, correct?
Exactly. Collision coverage, and the next coverage we'll discuss, almost always comes with a deductible, which you choose when you buy the policy. Common amounts are $250, $500, $1,000, or even higher. Choosing a higher deductible typically lowers your premium for that coverage, but means you'll pay more out of pocket if you have a claim.
Okay, so collision covers damage from hitting things or overturning, regardless of fault, minus my deductible. What's the other part of Part D?
The second part is called other than collision coverage. This is often referred to more simply as comprehensive coverage, or sometimes COMP. As the name suggests, this coverage pays for damage to your car resulting from losses other than a collision or overturning. And having both collision and comprehensive coverage is often referred to as having full coverage on your vehicle, although that term isn't technically precise.
What are the main factors that insurance companies look at when deciding how much you personally will pay for your auto insurance? We touched on some, but let's list them out.
Right. Auto insurance premiums are based on a complex calculation involving a wide array of rating factors. All of these factors are designed based on the insurer's data and actuarial analysis to predict the likelihood and potential cost of future claims specific to you, your household drivers, and your vehicle. The source lists these critical factors that typically have the biggest impact.
What's usually at the top of the list?
Your driving record and the records of anyone else listed on the policy who drives your cars. Past accidents, especially at-fault ones, and traffic violations like speeding tickets, DUIs, reckless driving, are very strong statistical predictors of future risk and will almost always increase your premium, sometimes significantly. A clean record generally gets you the best rates.
Makes sense. What else is huge?
Your location specifically, where the vehicle is primarily garaged and driven. Rates can vary dramatically by state, by city, and even by zip code within the same city.
Why such big differences based on location?
It reflects differences in factors like traffic density, accident frequency, rates of vehicle theft and vandalism, road conditions, weather patterns, hail, floods, the cost of medical care and vehicle repairs in that area, and even the local legal environment, how litigious it is. Areas with higher historical losses generally have higher base rates.
Okay, driving record and location are big ones. What else?
Your age, gender, and marital status are often used as rating factors, although the use and impact of these can be controversial and are regulated differently by various states. Statistically, younger, inexperienced drivers, especially males, tend to have higher accident rates than older, more experienced drivers, and married individuals sometimes have lower rates than single individuals, based on insured data.
Right. There's demographic factors that correlate with risk, even if controversially.
Yes. Then there's the make and model of your vehicle itself. This is important for several reasons. The vehicle's value affects the potential cost of a collision or comprehensive claim. The cost and availability of repair parts, its safety ratings, how well it protects occupants and avoids accidents, and its likelihood of being stolen all play a role in its risk profile and premium. Sports cars often cost more to insure than sedans, for example.
The car itself matters. What about how you use it?
Absolutely. How you use your vehicle is a key factor. Are you using it primarily to commute to work or school every day? If so, how many miles? Or is it just for pleasure, driving on weekends? Are you using it for business purposes, which might require commercial policy? Generally, the more miles you drive per year and the more you drive during high-traffic commuting hours, the higher your exposure to accidents, which can increase your premium.
Mileage and usage patterns. Anything else major?
And finally, as we discussed in detail earlier, your insurance credit score, is used as a significant rating factor by most auto insurers in states where it's permitted. A better score generally leads to a lower premium, reflecting that statistical correlation insurers have found between credit characteristics and insurance losses.
Wow. So when you get that auto insurance quote, there's a lot more feeding into that final number than just, I drive this particular car. Your personal driving history, where you live, your age and other demographics, the specific vehicle details, how much you drive it, and even your credit behavior. It's all being analyzed and combined to predict your specific level of risk for the insurance pool.
Precisely. It's a multifaceted assessment aimed at classifying your risk as accurately as possible, so the premium charge aligns with the expected cost you bring to the pool. Understanding these factors not only gives you insight into why your premium is what it is, but also suggests potential areas where you might have some influence, like maintaining a clean driving record, choosing vehicles with good safety ratings, or potentially improving your insurance score over time. It all circles back to that core function of insurance: predicting, classifying, and pricing risk to ensure the pooling mechanism is funded adequately and fairly for everyone involved.
We have definitely come a long way in this deep dive. We started right at the beginning with those bedrock concepts of risk transfer and pooling, saw how they're powered by the statistical magic of law of large numbers, but also constantly challenged by things like adverse selection.
The fundamentals.
We explored the different structures of the companies that provide this vital service, the stock companies focused on shareholder profit, the mutual companies focused on policyholder value, and the myriad ways they actually reach you, the customer, through various marketing channels.
Right, through agents, brokers, direct online, all those pathways.
We pulled back the curtain to look behind the scenes at their crucial internal operations. How they handle claims fairly and efficiently, how they use reinsurance to manage their own catastrophic risks, and how their investment activities are so critical to their overall financial health.
The operational engine of the business.
We learned how to decipher their financial performance using industry-specific metrics like the combined ratio, checking their underwriting profitability, and the overall operating ratio for the complete picture.
key numbers to understand their success.
We came to appreciate the vital role of state-based regulation in protecting the public interest.
The necessary oversight.
We delved into that specific and sometimes contentious tool insurers use for predicting risk, the insurance credit score, understanding how it works, and the debates surrounding its use.
A complex tool for sure.
And we wrapped it all up by bringing it down to the street level, breaking down the specific coverages, liability, med pay, uninsured motorist, collision, comprehensive in something as familiar and essential as your personal auto policy, and seeing how all those risk factors feed into the premium you pay.
It's been quite a journey through the world of insurance. From abstract principles to concrete applications, we've really seen that insurance isn't just some static product you buy. It's a dynamic, complex system for managing pure risk in an uncertain world. It's built on sophisticated statistical prediction, grounded in important legal principles, and managed through rigorous operational processes.
Yeah.
All ultimately aimed at providing a measure of financial security and peace of mind against potential misfortune for countless individuals and businesses.
And hopefully, really hopefully, understanding these principles and practices empowers you, our listener, to look at your own insurance policies and relationships with greater clarity. Maybe to see insurance not just as a necessary expense, but as a powerful tool you're actively using to manage your personal or business risks. To understand a bit more about why your premium is what it is, and maybe feel more confident navigating the important choices you need to make about the types and amounts of coverage you need.
Absolutely. That understanding is key to making informed decisions. And, as we look ahead, it's worth pondering. The very nature of the risks we face as a society is constantly evolving, isn't it?
What do you mean?
Well, think about the growing impacts of climate change, more frequent and severe weather events. Think about the increasing sophistication and prevalence of cyber threats impacting businesses and individuals. Think about emerging technologies like autonomous vehicles, which the source material likely touches upon in risk management context. How will they fundamentally alter concepts of auto liability and risk?
That's a really interesting point. How will these massive shifts challenge the fundamental principles we've discussed today? Things like pooling diverse risks, predicting future losses based on historical data when the future looks so different, maybe even the regulatory approaches designed for older types of risk.
Exactly. What new models of risk transfer or risk pooling might need to emerge to manage the fundamentally different, perhaps more systemic, risks of tomorrow? It really leaves us with some fascinating and, frankly, crucial questions about the future adaptability of this ancient yet ever-evolving concept of sharing risk.